Hello, and welcome to McQuilling TV. I'm Claire Schmidt, and joining us again is Connor Stone, Marine Transport Advisor with McQuilling Services. Welcome back, Connor.
Thanks for having me, Claire.
As you stated in the McQuilling recent short-term outlook, the IMF recently downgraded the U.S. GDP growth estimates for 2017. What could this mean for tankers?
A 0.2% decline in economic output could lead to lower U.S. product demand, most notably gasoline, which has stagnated this year. So decelerating or declining demand could lead to more product exports to markets such as the Caribbean, where the Salina Cruz refinery was recently shut down. And this is located in western Mexico and is likely to not restart until August 20th. So we may see more U.S. product volumes being pulled into the Caribbean.
I see. So little support for the clean tankers in the Gulf. Can you tell us a little bit about the Asia market?
Of course. Well, the near-term outlook for clean tankers trading in Asia is not as positive as for the Gulf. And this is because gas oil refining margins are expected to decline over the coming months due to an increase in regional supply. Now, when we look at China, there's been some recent sulfur regulations that were implemented on July 1st. And these might hinder the flow of imports of high sulfur light cycle oil, which has been used recently to feed domestic demand over ultra-low sulfur diesel, which has been freed up for exports. So we may see a little bit of pressure on export volumes, and we have to consider this in the context of the fact that Chinese refinery intake is likely going to stagnate over the coming months.
Very interesting. Okay, so before I let you go, I just want to hear some of your comments about dirty tankers in reference to the recent buzz around Nigerian crude production.
Well, we've seen a resurgence in Nigerian crude output. Actually, through May and June, we've seen the first year-on-year increases since before 2016, amounting to about 190,000 barrels per day of additional output. Now, West Africa as a whole is expected to add more support for VLCCs and Suezmaxes in the coming months due to a rise in regional crude balance to about 4.4 million barrels per day over the second half of the year. Now, thinking about Nigeria, there are some talks about inclusion in the OPEC production cuts, which would likely stop any production gains and put some pressure on export volumes. Now, for Suezmaxes, this is especially difficult because there's a huge delivery schedule for the rest of the year. We're expecting about 39 more vessels through the rest of the year, which is going to put some serious pressure on rates. Actually, TD20 in August is likely to average around world scale 63, which would be a year low for 2017.
Wow, that's a really large delivery schedule. Connor, thanks again for joining us and sharing your views on the market.
Of course, I'll come back anytime.
That wraps up another episode of McQuilling TV. Thanks again for joining us.